On today's show, 3 questions. Number 1, why is this bad news? Number 2, when could the bubble burst? And number 3, are Trump accounts legit?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome back to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. And you're back. We're
Hello.
back, Rabih.
We are back. How are you, Matt?
I'm great. How you feeling?
Dude, I'm hyped. I went on 10 days to eat food, and it was incredible. I did listen to you guys telling me to have a good night's sleep on 2 cents. Well, there's a 14-hour difference, so it was more like breakfast. But you guys were involved in my trip, and
we should have said good morning. I'm sorry. It's just that I told you last few times you've gone on trips and you've been away, you told me you listen at bedtime, so I was trying to tuck you in at night.
Well, honestly, this is weird, but when you're so out of your comfort zone in a very new environment, sometimes you latch onto very weird things to find stuff that are familiar. And for me, it's your voice.
You and every dentist out there.
Yep.
I don't think that's true, but I'm glad we could be helpful. And I'm glad you had a great trip. You said the jet lag is still hurting you?
The jet lag is definitely tough. I can't fall asleep until like 4 a.m. But, it was great. It was a foodie trip. I've been known to send clients cooking books, right? So I'm staying on brand. Went on a 10-day food tour in China with one of my favorite food creators. Her name is Blondie in China. And she just took us for 10 days into hidden gems, eating so many meals. It was delicious. Fun, but delicious. It was great.
So cool. You relayed to me a couple things I want to highlight. Number 1, the craziest thing I heard you ate was a live octopus.
That was in Korea on my way back, just
on your way home.
Being a foodie.
So Let me get this straight. You do a 10-day excursion, foodie excursion, eating like every few hours, all these crazy different things.
Mm-hmm.
And then you decide on your way home, why don't we just pop over to Korea and eat a live octopus?
Yes, man.
Yes, man.
I'm trying to defend myself here, but I'll just say, just like there's unlimited greed in the stock market, there's unlimited hunger for foodies, and I just suffer from it.
I love it. The other thing I want to highlight really quickly that this needs to be called out is you flew home from Korea, 10-hour flight.
Yeah, the funniest thing is that I went through an hour telling you about all the dishes that I've eaten and all the stuff that I've seen, and you were not impressed by this piece of information. So
it
please
was
share it.
Shocking that you got on the plane. You said you fell asleep and you woke up on the tarmac in Seattle.
Yes. Well, just to give you some
10 hours,
which is fine. This is not my record. I've done worse
on a plane. What?
I slept for 2 hours between China and Korea, and then I had 14-hour layover in Korea. I decided to go out, adventure, eat weird food. I walked 30,000 steps that day. I was exhausted. By the time I got in my seat, even before we left the gate, I was snoozing. I was
passed out.
Woke up in Seattle. It was great.
I think the reason I cling to that is because I'm so jealous of the fact that you can do that. There's no chance I could sleep for 10 hours on a plane. Like that would be amazing. If you fell asleep and 10 hours later you wake up and you're home, like that'd be incredible. So I'm happy for you. I'm happy you had a great trip.
Thank you. You'll struggle with the jet lag afterwards, but it's great.
But it's worth it. Yeah. Well, it's good to have you back. Let's jump in. Rabih, tell us about the bad news. Why is this bad news?
Well,
what bad news do you speak of?
It's not supposed to be bad news. And I had a different topic for this morning, but I woke up and I saw the markets and the markets weren't enjoying it. And I scrolled down to see it. And the news literally says, the U.S. economy added 172,000 jobs in May of 2026.
Which was higher than expected, right?
Well above the forecast of 85,000.
Yeah.
So like almost 90,000 more jobs, or double the amount of jobs. And you know what? The market that has been churning up for the last 2 weeks, making all-time highs one day after another, decides to do? Sell off.
Yeah, why not?
They were not happy with that. But it all makes sense. So let me tell you why this is not good news for the market itself, whereas it could be good news for the economy. There's a dissociation between the two. So just to get people back on track with me, I've been out. So here's where the economy stands. The economy is in a really good shape. As of now, we're forecasting that the second quarter of GDP is going to grow at like 3% annualized term. This is a strong, healthy, in real terms, that's a strong, healthy growth for the US economy. The labor market, jobs, have been sitting in a state where everything is stable, but we're in a zone of low hiring, low firing. We're not hiring a lot of people. We're not firing a lot of people. Very calm, very stable, which has kept unemployment rates stuck at like 4.3%. Historically, that's low. Then we got inflation. Inflation was kind of under control until the Iran-US war started, staying longer than we expected it to stay. Oil prices are still elevated in the 90-ish range, which I don't know if you guys are seeing it, but a lot of products are becoming more expensive, especially products that get imported or require a lot of shipping to be delivered to their final destination. So we're trying to see a little bit of inflation. And then the last point about the economy update is the elephant in the room, the new chair of the Federal Reserve, which you did mention on the last podcast, by the way.
Kay Warsh.
The Federal Reserve is meeting 11 days from the date of the release of this podcast. So in 11 days, the new Fed chair is coming, making their first speech. I don't know what changes they're going to be making. And I heard a rumor that they might remove the summary of economic projections, that's my new car smell, Matt.
Oh my gosh, they can't do this to you. They can't do this to us.
Is this the first impression he wants to leave?
No,
we'll
see. Can't do this.
We'll see. It's all hypotheses till now, but they
Is that
might
pressure from Trump, Rabih? Is that Trump pushing that?
No, but because his strategy is like, we're not that data dependent as a new Fed, and we don't do forward guidance. That might be why he might not use the summary of economic projection.
Is that something you want to hear as the new Fed chair? Like, we're not data dependent? What does that even mean? Or are we vibes dependent now?
No, he's more like, because we have the tools to steer the economy where we want it, these data that are lagging a month behind, they're irrelevant. They are noise. This is the type of thing. So, for example, I'm going to get so many chances to talk about this in the next couple of weeks, I feel like. But to give you a little snippet about it, is like, instead of us just looking at the big inflation number, let's trim the extremes that are too low and too high and really look at the core of the core and see if that's trending. That is the changing type of their philosophy. So, there's this saying that expensive news today is free tomorrow. So tomorrow we're gonna know what's gonna happen when they meet. But this Federal Reserve is coming with an idea that they want interest rates to be lower and they want to reduce the size of the balance sheet. But inflation is starting to, trickle in and be contagious into other parts of the US economy. On the other hand, we started getting more data about the labor market, which might raise question marks. So earlier in the week, we got what we call the job openings, which is how many jobs are available in the US for, the labor force to occupy. And the job openings in the US increased in April, in May by 731,000 to bring us up to 7.6 million jobs available. Market expectations is that we would have 6.8 million jobs available. So suddenly, that regime of low hiring, low firing now means there's more hiring, but we still haven't fired. This is very similar to what we had back in 2022. In 2022, we had around 2 jobs for every available person looking for a job. Now we're in like the 1.4 range, but we're ticking back up, which is inflationary, which is expansionary. And on top of that, we got the data today that said, more jobs were created, 175,000 jobs. So what does this mean? Inflation showing up, labor market is now in an expansionary mode just based off these 2 reports. This means that this could be a small cycle of new inflation, just like what we saw in 2021. And that is the complete opposite for the narrative that the new chair of the Federal Reserve wants to push. A new inflation, well, You can come with your own agenda, etc. But numbers do not lie, and this probably means that interest rates will have to go higher. That is why equity markets, as of today, actually had their first, I would say, breather in a couple of trading days where they slashed down rather than continuing making their all-time highs. We'll see what happens, but as of this moment, there's a 70% chance that interest rates will be higher by the end of the year than they are today, according to current market prices.
What a flip, right? We
Yep.
talked about this. It's increased from even last time we talked about it, which I think was last week or the week before. Giving the percentages, it was down in like the 60s. But yeah, now it's, you said 70% chance that we're actually going to raise rates as opposed to lower them. So it's just amazing to me how quickly things can change. How much of this, Rabih, too? I mean, I know we're just guessing, but we know like a lot of times short-term market movement is not the same as long-term market movement. How much of this is just like, I like how you said, like the market's taking a breather, is like just sell off, like just like people taking gains, or, you know, it not being anything to do with news. It just like we've had such a crazy run the last couple of weeks, couple of months. How much of this is just kind of like one day blip, people taking some gains off the table?
I think it's more signal than it is noise, because yes, the equity markets are noisy and it could be a one-day blip. But if we look at the fixed income market, if we look at bonds, if we look specifically at 10-year interest rates, treasuries, they have ticked above the 4.5 level, which they have been going up for the last couple of days. This means that smart money, big Wall Street, is already pricing in this new economic regime slowly. Do we hope that, I don't know, like, here's the thing, we're heading into a certain direction and the indicators are clear, but this does not mean that we could not pivot again, just like we pivoted into it. So, you know, let's do some fan fiction for fun. The war ends tomorrow, oil prices back below 70, you know, we have data centers on Mars and on the moon. And it's like, and suddenly everything opens up. You might expect interest rates to go back down, and then expectations of lower interest rates to be priced back in.
Yeah.
So far, not.
I mean, just like it flipped quickly to this side, to the upside of now saying that chances are rates are actually going up. It could easily just as much flip the other way, like you said. And
100%.
It takes one thing. Most likely right now is if they can never figure out what's going on in Iran, which I love how they pump fake us. They're like, yep, we got an agreement. And it's like, oh, no, we're bombing again.
Oh, yeah. We'll probably do another episode with an update on what's going on there. But yeah, it's a mess.
It's a mess. It's a mess.
Okay.
Okay. So the other last thing I'll say on this, Rabih, is it's just always, it never ceases to amaze me how quickly things change of what we care about, meaning the market, and how it never ceases to amaze me that one data point in a different context means something different in another context. Like a completely different context, this job data is like, this is amazing. Coming out of a recession, right? If we were coming out of a recession right now, this type of news would be so welcomed and would probably jump the stock market, you know, multiple points. But because of the current environment, this same data point is completely negative. And on one day, all we care about is the Iran conflict. And really now all we care about is inflation. It's just, it's hard to keep track of, like, again, what data point means what in the context, and then what we actually even care about.
And this is why, like, it's so hard to beat the market. That's why models and algorithms keep failing, because just like we are having cognitive dissonance, like, what do you mean we hired more people, but this is bad for the stock market? The same thing, it breaks the math and you need to readjust and recalibrate. And that is why the proper approach to investing would not be to hold the narrative and ride the wave with it, because that narrative can switch really quickly.
So quick.
On the contrary, a position that's robust and can do well whatever trajectory the markets take you, regardless of the narrative that the market is adopting, is more of a winning strategy in that situation.
Love it. Okay, well, talk to us about when the bubble is going to burst. I'm assuming you're referring to AI here?
Or what would you think we would be thinking about?
I mean, my first thought was AI.
It is AI.
Okay.
Is there anything else we could be thinking about?
I was going to say, I don't know what else there would be.
No, so I've been reading some research about AI and about, not really specifically AI, but about technology in general and how technology changes economies and how sometimes that could lead to booms and busts depending on how quickly a technology gets adopted and what utility you can generate from that technology initially. So, and there are two main hypotheses, I would say, right now for, what is the market that the AI is trying to change. So the first market would be, the IT sector. Like right now, we're not going to be using software anymore, and AI is just going to replace all of our applications and all of our software because agents are going to do stuff for us. But it's just upgrading your software. That is a very small market, right? That's probably like a $2 trillion market. But there's also another market related to AI, which is, will AI be replacing not the softwares, but the humans, which is the narrative that we keep hearing. AI is replacing our jobs. AI will be able to do work that humans could do completely. If you're replacing humans, like the full cognitive behavior instead of just the software, well, that's a much bigger market. $20 trillion impact on GDP. Like it's a much larger impact. So this tells you the size of the market and whether you're oversupplying the market or undersupplying the market. The whole idea with the bubble bursting is just like in any other technology. Think of the best example I could give because that's the most relevant in people's mind. Think of the .com period. .com period, internet is the new player in town.
Yeah, we've seen this before.
Everyone is building capacity for the internet, whether it has utility, it has usage or not. How many stupid websites were there that are of no use, right? But everyone laid down their fiber optic cables and prepared the infrastructure for it.
Or back then, Rabih, it wasn't even companies that were doing anything on the internet. It was just adding .com to their name. They just added .com to their name, and all of a sudden their markets, jumped. Their price jumped like tenfold.
100%. And now they add AI to their name, right?
Yeah.
So the whole idea was you are creating new capacity, you're introducing new supply, like when you did in the .com period, but there wasn't really an immediate usage to it. That created a bubble. And then when, macroeconomic situations such as inflation or a war or a drop in demand happens, it bursts the bubbles. And then the .com crash happened, etc. So the question would be, this AI hyperscaling, this new supply that's being added to our economy as a function of this new technology called AI, is it putting us in this fragile position where any external shock would pop the bubble? And the question would be, it really depends on the market we are dealing with. If we think it's just going to replace softwares, and I know you have your own opinions, Matt, about the whole AI thing, but if we think that AI is just going to be replacing the softwares, and every new company now will have on top of their chief technology officer and their IT people, AI people, but nothing else will change in that front, then maybe we don't need that many data centers, and we do not need to ship data centers to low Earth orbit, and we do not need to have that high valuations on these technology companies. That is a bubble situation. However, if we really think that AI is really out there to replace all of our jobs, and I will just have some mini agents like me where they are trading the market and I'm enjoying good food, then probably, yeah, we do not have enough data centers because we need to service all the working force around the planet. So we are at this position where once we define what the market is and what the demand is, we can determine whether if we are undersupplied, perfectly supplied, or oversupplied. If we are oversupplied, we're just building that capacity without any usage for it. That is a bubble environment, and an external shock would pop it. Before I go further, what's flashing on your mind?
Yeah, so I do have totally ignorant takes on AI because I'm not even close to considered even a novice in this space. But we talked about this one of the weeks you were gone, and then Jake and I did another podcast about it. I've kind of flipped on this a little bit where I totally admit I went from initially I was like, oh man, this does feel way different. Like this is going to be very different than past technology, innovation, market disruption. I was like, this is going to be different. And I've since come back to earth a little bit. I was giving into or falling prey to some of these clout chasers who were posting and being like, all the jobs are going to be gone in 2026 type of thing. I've since come back to earth and thought,
is that a pun for Elon Musk? No pun intended.
Maybe.
Okay.
Yeah, I think I've just kind of come back a little bit and thought like, yeah, there's going to be some life-changing things about this for sure. But I don't think it's going to be as disruptive as what a lot of these clout chasers are saying. And on the contrary, I actually think it could just make the economy and it's certainly going to change things. It already has and will for sure, but I don't think it's going to be as negative as what people think. I actually think quite the opposite at this point, where I actually think this is just going to make jobs easier for everyone.
I agree. No, I agree with you. And I think the point that I would add, and the point I wanted to get to after, is that, for example, when the bubble bursts, when the bubble bursts, what is going to happen is that suddenly you're going to have very cheap infrastructure for new players to come in, rent it out, use it, and build the new technologies. And if I want to give an analogy, back in 1995, or 1999, the internet was this big thing. We were experiencing what we are experiencing right now with AI. But back in 1999, you could live without the internet. And right now in 2026, we still could live without AI. I could live without AI. Like, my life doesn't really differ that much. Fast forward to post-bubble, and now we're in 2015. I don't think I can live without the internet. Because the internet in 2015 is completely different than what it was hyped in 1999. So I'm thinking 2026 AI, I can live without it. A lot of change is going to happen. New players will emerge, but the AI landscape in 2035, probably I can't live without AI then. That is when AI is going to be changing our lives, not the 2026 AI.
Okay, this is perfect, Rabih. Can I read you something? I'm sure you've heard of this, the Gartner hype cycle.
No.
Okay, I'm going to read you this because this is, you literally just were talking, what you just said is this. Okay.
Oh, really? Okay.
So Gartner hype cycle, this was created in 1995 by Gartner Inc. And it's a model that represents the maturity, adoption, and social application of specific technologies. Okay. So it helps investors, businesses, and consumers understand whether an emerging technology's buzz is based on real viability or inflated expectations. Okay. There's 5 distinct phases. Let me just read these to you.
Okay.
And because it's kind of amazing what you just said. So number 1 is the innovation trigger. So this is the technological breakthrough. It kicks off the cycle. It's the early proof of concept stories and media interest triggers significant public attention, often without any viable commercial products yet. So number 2, we can decide where we're at in this cycle. Number 2, the peak of inflated expectations. Enthusiasm and publicity creates a wave of hype. Early success stories are heavily publicized. Many failures go unreported. The technology is often viewed as a cure-all, and investments pour in. Number 3 is the trough of disillusionment. So reality sets in. The technology fails to deliver on its immediate outsized promises, causing interest to wane. Early adopters struggle with performance issues at implementation, leading to negative press and abandoned projects. So I'm going to get to the next 4, but really quick, I would say, I want to get your take. I think we're still in cycle 2 or part 2 of the cycle.
2.5, 2.6.
Yeah. I think we're starting to see signs of getting into that trough or like a pullback or a drop from the peak. I wouldn't say we're in the peak right now. I think we've probably peaked.
Probably. Yeah. Once people started questioning whether all these data centers really need that much energy and that water and whether it's economically viable to do it to start with, criticism came in. People are having, the day after thoughts where they're not high on the hype.
Yeah. Yeah. Well, I'm also going off of like what I'm seeing in media, and I'm seeing from people like Torsten Slok and these podcasts where you're starting to hear more. There's a wave more of like counterpoints of like, let's pump the brakes on AI. So I think that's growing a little bit. Okay. Number 4. So after the trough. So basically it's saying we have this peak, we have a significant drop, and it almost goes the other way in this trough where people start to say like, this is kind of bull crap. Number 4 is the slope. They call it the slope of enlightenment. So organizations begin to understand the technology's true capabilities, real limitations, and then real world use cases. 2nd and 3rd generation products appear as more practical applications are proven. And then number 5 is the plateau of productivity. The technology becomes widely adopted, stable, and economically viable. Its real-world benefits are clearly demonstrated and accepted, moving it from a niche novelty into the mainstream.
So that is the AI of 2035, right?
So you literally just said it. It's so crazy because you just described it. Gartner in the 90s put this into a model, and like it's so crazy to see this kind of stuff because it's like, oh, this explains it. Like, massive hype, over expectations. We have a equally negative response at some point where people are like, yeah, this is not what we thought. And then it kind of creeps back up and then fully adopts. So I'm totally agreeing with what you're saying of like, and I think the internet's the great example. And I think we're seeing it now with AI. It's like AI is going to change the world in some form or fashion. It already has and will continue to do so. But it is certainly not the cure-all. And it is certainly, in my mind, not taking over every aspect of the economy. That's the echoes of overhyping it. 100%. So I think what you said was perfect, where it's like, we're going to see a world at some point in the next couple of decades where nobody can live without AI. But that is not today. I love that.
Today, which brings us to the point I wanted to make today, because we are not experts on AI, but we manage money for a living. And I'm trying to think, because the amount of messages that we've been getting from clients asking us about certain stocks or certain sectors that are going to really do well out of this situation, try to pick them, try to find the best winner. Honestly, I struggled until I kind of like, I'm going to use this framework and run with it. So if you have this framework where you know that, yes, this is infrastructure that's going to be very influential in the next 10 years, but you do not know who the winner is going to be in 10 years, it makes you start adopting a different perspective. Instead of rushing into, as a portfolio, I'm thinking now like as a portfolio manager, and our clients can think like, as a dentist myself, I have my own practice, and there's this AI shift. Would you now suddenly fire all your, hygienists and receptionists and just add these AI tools for scheduling and then do the imaging online? And then if something shows, you're not going to do that shift immediately. So why would you do that shift immediately in your portfolio, where you suddenly are asking to concentrate a big size of your portfolio into, a fund that is only concentrated in 15 stocks that are the hype right now? We do not know which company after the boom bust is going to be the big wave. And a really good example of that I like is that Warren Buffett, the famous and infamous Warren Buffett, did not really invest in the .com that big. He always, was a proponent of his insurance company and Coca-Cola and McDonald's and Costco, right? But Warren Buffett's best investment was in Apple. But Warren Buffett did not join Apple and add it to his portfolio until 2016. So Apple, as the star of the .com era, did not become a good investment until 2016 for Warren Buffett. So thinking about joining some stocks or ETFs right now, or else I'm going to be missing the train, is nothing fundamental, is nothing based on the proper economics of it. It's nothing but FOMO.
Yeah.
And I don't know. I think it's our responsibility to, I'm not saying, hey, I'm not going to let you invest in these stuff, but it's my responsibility to tell you, there will be better opportunities. And you just have to be very strategic in your patience to actually make the best investment decision you could make.
Yeah, I totally agree. And another aspect of this, we've heard this a little bit lately, Rabih, where directly from clients and dentists that say, well, I think this is the next opportunity to find the next NVIDIA, or something along those lines. And we understand the desire there. Like, you see what's happened with NVIDIA and you're like, man, if I could find the next one, this could fast track my path to financial freedom. The problem with that fundamentally is I'm not even going the way of saying it's almost impossible to find the next NVIDIA. It is, but I'm not even going there. If you just take NVIDIA as an example, right? The fundamental bias and problem we have with something like this, where we look back and say, oh my gosh, look what NVIDIA did. What you are assuming is that you were able to weather all the storms NVIDIA has gone through. Just take 2018 as an example. NVIDIA was down something like 70% that year. 70%. And you're telling me rationally that if you had put $100,000 into that thing and saw it drop to $30,000, that you would have weathered that storm, that you would have not gotten out.
Not only did it drop to 30,000, but also you would look at, I don't know, something as simple as the S&P 500 and say, oh, my 70 grand could have gone to 90 with me doing nothing. Yep. So there's always that comparison while you're at the low.
Yep.
Like even us as professionals, and we try to avoid putting ourselves in a situation where you have to face that behaviorally. So
yeah. So I just want to highlight that this fundamental issue we have, this lens we look through when we're looking in the past and saying, we see everything that NVIDIA went through and we're like, oh, well, yeah, that was an opportunity. Like that dropping 70% in that year was an incredible opportunity. It's like, well, yeah, you're saying that from the safety of the present and knowing what happened. But when you are looking forward and you're saying, and you're holding that money and you're seeing it drop 70%, there's no person out there that's going to say like, yep, I would have held through that. And that's the problem with this is you're looking for the next NVIDIA. You're looking for the next NVIDIA's result.
Yep.
But you're not looking for the next NVIDIA's path to get there because that's a huge difference. Not to mention, it's just really hard and impossible to find. So I just wanted to highlight that. Any thoughts you have, Rabih, on that?
No, I love it. I think we hit all the talking points regarding, the AI hype and what you invest in. I'm looking forward to getting more emails and see what else we did not cover and come back to the podcast.
Yeah, please do. You can email us at podcast@dentistadvisors.com. Tell us, either post questions there, ask us a question, or tell us what we're getting wrong. We would love to get different perspectives. We are in no way are saying this is our 2 cents, but it doesn't mean it's right. It's just responses and thoughts, but not saying we have all the answers. Rabih does, but not me. I definitely do not. Okay, Rabih, anything else on that, on AI or the bubble or anything like that? Okay, we'll finish up with another topic here, which is, are Trump accounts legit? And I want to shout out our team here, our advice team as a whole. So we meet every week, as you know, Rabih. We meet more than that, but one of the meetings we dedicate every week, we call it our mastermind meeting. And we come together and we share ideas, we share case studies, we share questions we're getting from clients, and we're trying to really just help each other and support each other and our clients in a collective way, because we know that not any one of us individually has all the answers. So it's just kind of the power of bringing our minds together. And we had a really interesting conversation last week, specifically about Trump accounts. And so we'll get into this. I'll give some of the basics. I'm sure if you're out there listening, you've probably heard of this at least, but I'll give you some basics. But we were talking about it. It was a really interesting conversation because we lasted probably 20, 30 minutes just on Trump accounts. And it started off with kind of the general consensus was like, yeah, this is stupid. Who cares? That was kind of like our thoughts. But as we kept talking and we were researching together and talking about, okay, well, let's not just throw these out the window. Let's talk about how these could possibly work. And I think it was Taylor, shout out Taylor Sutterfield, started to present a strategy of where this could work. And so we ended the conversation with like, man, these actually could be really helpful for our clients.
Okay, so you guys pivoted faster than the U.S. economy.
We did.
Let me know what happened.
We did. I'll tell you. So there's a very specific way I think these could be used, specifically for our clients, specifically for a high-income dentist. But let me take a step back and just give the basics of Trump accounts if you've heard of them, but you're not really sure what's going on. So Trump accounts, they officially launch. These are the accounts that Trump, as part of his agenda, created. They officially launch on July 4th, 2026, the 250th anniversary of the country. Shout out America. So they're tax deferred investment accounts for any child under the age of 18. And this gets confused. So I was talking to my brother the other day, who has 4 young kids, or youngish kids. And he's like, oh, well, I can't use a Trump account because it's only for babies born in this period of time. I'm like, no, the Trump accounts have been created for any child under the age of 18. There's an extra little boost. If you have a child born between January 1st of 2025, between then and then December 31st, 2028, you will get a $1,000 contribution from the U.S. Treasury. So those are 2 very distinct things. Anybody with a kid can set up a Trump account in the U.S. And if you have a baby born between that period of time, you get a $1,000 contribution. So those are the basics. And let me add a couple of things. Family, friends, the child themselves can contribute up to $5,000 per year. Again, it's after tax, so you're not getting a tax benefit on the front end. And then prior to the child turning 18, the funds stay in an account, must be invested primarily in the U.S. So low-cost index funds in the U.S. And then after 18, the account converts to a traditional IRA and becomes their property. So that's the basics. Anything you want to add or things you have, Rabih, on that?
Good. We're good.
So here's where it gets interesting. So when you hear the basics there, again, and you think about our clients specifically our practice owning clients is where this really becomes, I think, a valuable asset potentially. So practice owning client earning enough money to be maxing out their own retirement accounts, let's say putting away into a brokerage account. Ideally, you're in that 15 to 20% savings rate, right? You're doing your back to Roth conversions. Like you've hit these layers, right? Mm-hmm. You've hit these kind of levels of savings. But let's say you have extra cash. And one of the best tax saving strategies you can have is have your kids on payroll, especially if your goal is to save for your kid. So this is something we advocate for all the time. Caveat, this is not tax advice. Consult with your tax advisor. Was that pretty good? Was that nailed it? Yeah. Okay. So you meet this criteria. High income, you've checked all your boxes of savings, and you've got your kids on payroll and you've got a desire to save for your kids. So that's still a pretty unique, rather unique case. But if you fit this mold, here's where this could work. If your kids are on payroll, you're going to want to pay them, consult with your tax advisor, but you want to pay them most likely to max out this benefit up to the standard deduction. So in 2026, that standard deduction is $16,100. That means you can pay them up to that amount and they don't even have to file a tax return. They don't have income on paper. It's not taxable income. So that's an incredible benefit because you can take money at your highest marginal rate as the practice owner, pay your child, and they get tax, quote unquote, at 0%. So that's amazing. The first thing we would advocate for you to do in general for most dentists would be to max out a minor Roth IRA for that kid, right? So that is for 2026, $7,500. Okay. So $7,500, you now have $8,600 left over. You dentists out there, a lot of times like, well, what else do I do with this? So an option is a brokerage account for sure. No question. The other option is you can use that money. They can pay for their vacations or whatever. But here's where a Trump account, I think, enters the chat. Yep. Trump account enters the chat. $5,000 of that $8,600 that's left over. Think about going into a Trump account. So that money goes in, again, after tax. But in this case, that is 0%. So there is no real tax on that. It then grows tax deferred, right? So it's growing tax deferred in that account. Let's say you do that we're just going to use easy numbers. You do that for 10 years. You put in $5,000 a year. So now you've got $50,000 sitting in that account. The kid turns 18 plus growth, right? So it's got growth in it. At 18, that account transitions to a traditional IRA. Well, they're 18. Most likely they're not making any money at that point or not any real money. So then your child at 18 becomes their account. They can convert that account to a Roth IRA, convert it to a Roth, plus everything you've put into a Roth already in the minor Roth. There is a realistic scenario where your kid turns 18 and they've got multiple six figures sitting in a Roth IRA at that point that has been taxed at 0%. And even when they convert that amount, let's say it's 50, 60, 75,000, they'll pay some tax on it, but it's going to be pretty minimal. And then that money can grow tax-free for the rest of their life. We ran some numbers on this, and these are all general high-level numbers. But assuming your child, just like you're assuming you can stay in the video for turn the ups and downs, assuming your child will hold that money until retirement, you are literally setting your child up to a point where they would have multiple seven figures in assets in retirement. We talk about generational wealth. You talk about what this could open up for you as a dentist of either A, paying for their college, or B, just setting up a legacy for them. And if you did something like this, freeing up the stress of you having to worry about, your own assets and passing on assets. If you set them up in this way, using something like a Trump account, it's A, tax efficient, and B, an incredible way to teach your child about investing and saving for retirement. And C, it's doing it in a way that is, setting passing on a legacy for them. So I'm going to leave it there, Rabih. I've come full circle on this. I actually am going to be sharing this with all my clients and talking about this. I actually think Trump accounts have become more legit with this specific strategy than I would have ever thought.
Mm-hmm. I'm going to go give my dad a call. No, I like it. Let me cascade back to make sure I understood what happened. So in the certain situation where a dentist uses their business for a tax strategy where they hire their kids and give them some money up to the standard deduction where they can, from a business side, take the benefit of that. And from the kids' side, they won't have to pay taxes on it.
Correct.
Usually the struggle would have been that, out of this 16,000 standard deduction, I can only put around like $7,000 or 7,500 in a Roth IRA. After that, I can't really put it in a tax efficient vehicle. The Trump account comes in and tells you, hey, how about we also allocate another $5,000 that can be in a tax efficient vehicle? And this is the gap where it solves.
Correct.
So, and it goes up. Cascaded correctly?
You did. And here's the biggest thing. We advocate and have for a long time of like that additional $8,600 going into, let's say, a brokerage account, right? Yep. Which I think is still a great vehicle to use. The difference is that from that brokerage account, although more liquid for sure,
taxes
is not as tax efficient, and it doesn't allow you to take that and put it into a Roth. That I think is the key here. I think a Roth is, if not the best, one of the best accounts in existence. And if the main priority, right, there's a huge caveat here. If the main priority is, say, I want to set up a legacy for my children and set them on the right path towards retirement, the Trump account is, I think, a great option for this, and something that is different than a brokerage account because it allows a pathway to a Roth IRA. And really front-loading a Roth IRA, you're close to doubling a contribution to a Roth IRA over the course of their life per year. Not quite, but you're getting pretty dang close. Not only are you maxing out the minor for them, but by the time they turn 18, you've now taken all those contributions and put it into a Roth. It's just an incredible way to save for your children. One of the most efficient ways, I'd say.
I'm sold. I'm sold. I didn't make a full 360 turn like you did, or 180 turn like you did. I'm sold. So it's a really good idea for business owners in this country who have their kids on payroll. But the Trump account has been marketed as this account that works for everyone. And in this situation, it's not 100% true, because a Roth, just a normal Roth or a normal IRA, could have better taxable benefits. Because,
yeah, totally. And if you're out there listening and thinking, well, I want to have a portion that's not just in tax efficient accounts for retirement for when they're 50 or 60. I want to have a slush fund of assets to pay for a wedding or help them buy their first house. Technically, you can still use a Roth for that. But A, I totally get that, and you might not want to put everything into the Roth. But B, right now we're saying $8,600 left over after the minor Roth IRA contribution. You've got $5,000 going into the Trump account. That leaves $3,600 left over that I would put into a brokerage account at that point. So you're still building. So anyone with young children out there right now, let's say your kids are under the age of 5 or under the age of 7 or whatever, you do this for the next 10 years, you've piled up a ton of money that will eventually sit into a Roth. And then you still have quite a bit of money that you've been able to build into a liquid brokerage account. And I think, again, the biggest thing here is, I think if done correctly, this can take so much pressure off of a dentist who's got in the back of their mind this legacy for their kids. And they almost have in their mind like, well, I've got to be thinking about these assets that I built for myself and it going to my kids. If you do it this way, I think it can free up that stress. And now you start to live more intentionally for yourself around using your assets to kind of the Bill Perkins die with zero approach of like, I've taken care of my kids. They're good. I've done it through my business. I've done it tax efficiently. And now all my assets can be used to make memories and use it the way I want to use it. And I'm not going to leave them anything from my bucket because I've already set them up so well. That's maybe kind of like this utopia world, but I don't think it is. For the right dentist, I think this could actually work really, really well and serve both purposes.
Yeah, I love it. If your intention is to leave a legacy for your kids, instead of you having to do it in the last chapters of your life, do it as soon as that intention shows up and let compound interest help you along the way.
Yeah. Yeah. And by the way, doing it this way, where there's accounts in their name, but you are the custodian, I think there's a huge opportunity here to, as opposed to like leave them a legacy of just money and like, I die, you have this money, along the way, be teaching your kids about it, about investing, about the discipline of compounding and patience. And again, I know I'm speaking theoretically. It's I have 2 young kids. I know
You're
this is
very passionate about this topic, and I'm all for it.
Yeah. Well, I have 2 little kids, and I know that like the theory of, I have these sometimes glorious ideas in my mind of like, I'm going to sit my kid down and share this wisdom with them. And it's like, my kid's like, look at that butterfly. It's like, it's not that easy, but theoretically, I think this is a more efficient way and a more intentional way to leave a quote unquote legacy for your children than just doing it with some portion of the assets you're building. So kind of summary here is I've come full circle. I actually think for the right dentist, Trump accounts are an incredible vehicle and can be used really efficiently and under the right circumstances. So if you have questions, if you want to talk to us, we are here to talk to you about it. You can go to dentistadvisors.com, book the free consultation button. Rabih, anything else you want to add to any of this?
No, I loved it.
Covered a lot.
This was the surprise of the season. You flipping on the Trump account. I don't think anything else will beat it in 2026. We'll go from there.
And there may be something I'm missing. So let me know if there is. But I feel like this is the comeback of the year, the flip of the season for sure so far. Okay. Well, Rabih, good to have you back. Feels like we're home. Feels like we're home. We're back at it. Feels really good. Glad you had a great trip. Hopefully by the time the summit rolls around next week, you've fully recovered from the jet lag.
Yep.
Yeah.
Or I'll just miss my speech. What would happen? That's fine.
You what?
Just miss my speech because I
you just follow. You sleep in for your speech. Yeah. If you are hearing this and you want to have a last second entry into the Dentist Money Summit, you can. This is the last final shout out. I think I said that last week, but I lied. dentistmoneysummit.com. You're going to be hearing this over the weekend, so you better jump in there. It's in midway coming up this next week. So for now, everyone, thanks so much for listening. Rabih, thanks for sharing your words of wisdom. That was our 2 cents. Till next time, have a good weekend. Bye-bye.